Hello and welcome to Commodity Champions. I'm Manisha Gupta. The US Fed Reserve's decision to raise interest rates for the second straight month was echoed by most global banks. This aggressive action by central banks to curb surging inflation has sent commodity markets into a spiral of volatility. The aggressive tightening has also led to fears of recession, which poses to be a further downside for the market. Experts believe that prices will remain volatile for the long term, with a mild negative bias in the short term, as recession fears will further destroy demand. Metals have followed the same pattern, with prices declining from highs this year. Strict COVID measures in China, along with global PMI at its lowest in almost 2 years, has dampened demand for many of these metals, in turn hitting prices. So will recession fears keep demand dampened? And how much further is the downside for all of these metals? To answer all of those questions and more, I'm now joined by Peter McQuire, CEO of Exim Australia. And joining me also on the show is Guy Wolf from Marex. Gentlemen, hi, thank you so much for joining us. I'll start with metals first, and I'll start first with you, Guy. We have seen a lot of volatility come in case of these commodity markets. If you look at these all-time highs that we saw in copper, in case of nickel, in case of aluminum, we've seen prices come off very sharply from all of there. What's your sense, first of all, for the kind of volatility that we've seen in this year?
As you pointed out earlier, kind of three waves of demand destruction. First, it wasn't actually metals prices themselves that caused demand destruction. It was the impact on energy prices, which obviously hit household budgets, triggered the sort of global demand destruction that caused all commodity prices to come off. Secondly, the severity of the Chinese lockdowns, obviously single largest source of commodity demand, huge demand destruction there. And then finally, the inflationary impact and the fact that, again, unusually, the Federal Reserve has been the most aggressive in raising rates. That's driven a significant dollar rally, which is a huge headwind for commodities. There's really three massive factors that have taken base metal prices down to the levels that they are. And combine that with significant sort of pullbacks in terms of risk, and sort of higher margin requirements at exchanges. Markets have been very thin, highly volatile, and subject to increased headline risk, which doesn't seem to be going away in the short term.
Guy, also, we've seen a bit of a rebound come in for not exactly a rebound, but tables being turning on US dollar index from those 20-year highs to not being able to hold around 105 as well. How do you see that impacting metals?
Well, I think all those facts I've just mentioned are obviously now well known, and I wouldn't say they're all over, but the ECB has now started raising rates, which you might argue they're a little bit behind the curve. So I think the outlook on a relative basis probably now looks like the US, maybe they're ahead of the rest of the world in terms of raising rates, which I think is why likely maybe we have seen the dollar peak in the short term as other central banks rush to catch up. Additionally, China, again, the economic data is coming through exceptionally weak, unsurprisingly, but as they sort of open up, cease these lockdowns, you're going to get a significant rebound in pent-up demand anyway. And that's before we even consider the possibility of additional stimulus to try and get the economy moving again. So I think a lot of those headwinds that have taken us down to these sort of levels are on the margin, at the very least, easing.
So, Guy, while you've spoken about the hike in interest rates, the speculative interest also dimming down a bit, and then, of course, there is withdrawal in liquidity because of these stimulus measures being taken away, the tightening of monetary policy, that is. How do you look at the actual demand and supply situation? Because that is something is amiss when the conversations about many of these asset classes seem to be happening, because we've turned more macro than micro in the recent few months.
It's difficult to assess in the very short term because we're talking about incredibly unusual scenarios with the world's largest source of demand locking down huge cities and huge regions, which is difficult. Is not anything really anyone's got much experience of. I think I look back to earlier on this year when base metal prices were at their highs, and there was absolutely no evidence at that time that base metal prices at those levels were causing demand destruction. And the reason for that is very often base metals are actually very small percentage component inputs to the end product. Even if nickel doubles, it probably adds a couple of percent to the cost of producing a Tesla. But energy is very different. The impact on the household income levels from sort of doubling of utility bills, that's much more material. So I don't think demand necessarily can't recover. I think supply also remains tight. there hasn't been significant investment in new supply for quite some time. That's kind of why base metal prices were at the levels they were at. And we still have major bottlenecks in global supply chains. And so the ability of global supply chain to respond to any pickup in demand is still quite low. So we could very, very quickly see the dynamics turn around and see almost sort of flash tightness appear once again in metals markets if those headwinds, as I mentioned, do indeed sort of turn around and become tailwinds in the short term.
Okay. Guy, when we started this year and the kind of all-time highs many of the metals were making, it was almost being called a bull cycle or even a super cycle in some of those commodities. And from there, from where we stand now, how are you looking at this year one? And two, are you also concerned about this being a recession, as we've seen the last couple of quarters not goes down so well for many of those major countries? And do you also think that the worst is behind us now?
I do think the worst is behind us, to be honest with you. Always very wary of anyone when they talk about a super cycle or super anything, to be honest with you, because markets have an amazing habit of proving people wrong. But yes, I think, that while central banks have sought to try and get ahead of any increase in inflationary expectations, the truth is that the rise in energy costs has probably done a lot of the job that raising rates would otherwise have had to do. So I think rates don't need to go. We're not talking about repeat of the 1970s here. I don't think rates need to carry on going up. I think energy prices have been a fiscal drag and have already slowed the economy. And so I think we're seeing it in the economic data. I think you're definitely at points where central banks will start, certainly the Fed, will start to talk down the prospect of future rate increases and let the ones that they've done feed through. But the supply situation has not structurally changed in base metals. There isn't any new supply coming online. The relative price compared to, you look at all sorts of other asset classes over the last 20, 30 years, base metals are still cheap in the context of many other asset classes. And there's no real price sensitivity when people need those components, they need them. And actually, they're relatively price insensitive.
Guy, another important trend that I was looking at is that the metal prices have declined in dollar terms more than they have in other currencies. How do you look at that trend?
Yeah, that's interesting. I mean, the correlation between base metals and dollar can sort of ebb and flow, but in general, a stronger dollar is a headwind. I mean, we're living in sort of really quite extraordinary times. I mean, it's hard to believe what's happened over the last couple of years. It's hard to believe we're witnessing a land war in Europe. It's hard to believe that we've seen China, almost shut down its economy after the world had previously shut down its economy over the last 2 years. So I think it's very difficult to, it's almost, you'd expect to see unusual things, I would suggest, in this market environment. I think sometimes you need to sort of take a step back and think sort of slightly bigger picture. I think what has fundamentally changed for base metals, supply is still deeply constrained. There is no new supply coming online. And if anything, I don't see a change in that situation. I think the focus when there is investment, from what I see from industry, is more on the decarbonisation agenda rather than on finding new sources of real supply. So, I still think big picture, this is probably still a long running bull cycle. And in some respects, it's better that base metal prices have come back, because that actually keeps the bull market running for longer, in my experience. There's no better cure for high prices than high prices, as we saw in 2008, 9, 10, when the super cycle really did crash.
Oh, well, yes. And even as we have seen prices correct from this year's high, many of these metal prices are actually higher than where we were in 2019. So that point is well taken. Also, IMF has cut global growth targets in this year. We've seen China not come out with stimulus as was anticipated in the previous week itself. And then there are these US and China tensions as well coming in. What would you want to watch out for as we move ahead from here?
Well, the Chinese data is going to rebound naturally. I mean, just as we saw when the rest of the world moved out of lockdown in 2020, if you shut things down, then simply restarting them causes a significant growth rebound. So I think China is trying to tread a delicate line in that it has historically overstimulated the housing market. It doesn't want to do that again, but equally it wants to prop the housing market up, to engineer a classic soft landing, which is a pretty difficult thing to do. So I think it's going to be somewhat wary about overstimulating it to address short-term requirement, given that you're going to get a big rebound anyway. It would be, the happiest scenario if somehow you get a gradual deflation of house prices, just fast enough to resolve the problem, but not too fast to actually put the banking sector under pressure. That's a very difficult line to tread, as the US found with the subprime crisis.
Guy, do I hear you say that we are still in a bull cycle? I mean, that is what you mentioned a few minutes ago. And how much of a downside, how much of an upside do you expect now for this year, perhaps next 6 months, 8 months, 12 months? What are you looking for now?
It's a dangerous world to make predictions with too much confidence. I wouldn't have predicted Russia invading Ukraine at the start of the year. I personally think we may well have seen the lows for the year, to be honest with you. I think the headwinds that we've seen, as I sort of mentioned earlier, in terms of energy prices, Chinese lockdowns, and indeed, rising rates, though all of those things are miles outside of any extreme someone could have realistically forecast at the beginning of the year. And whilst the Ukraine situation is clearly still ongoing, and it's hard to know where that leads, I think particularly the dollar and the Chinese cyclical situation we've probably seen the worst of that for this year. So I think net, I think things probably improve gradually from here, and we probably end up somewhere between sort of the lows we've just seen and the highs of earlier this year.
All right. I'm not pushing you for an exact prediction here, but would you say if the downside is done, it's perhaps 10% down, 5% down from here, but a 15% high from here? Would you be comfortable saying that?
Yeah, I think so. I think, $9,000 copper is very realistic.
And you have a favorite metal out there who you think is going to be more bullish?
I actually think probably nickel. I think that it's the one that obviously has been very much in the headlines, and therefore the one that people have been forced out of, the one that's sort of most expensive to hold, the one that's going to cost you most in terms of margin and credit, but equally is the one that's very, very central and core to the decarbonisation agenda and the transition to electric vehicles. And that's just an underlying trend that hasn't changed. And I think that would probably be the one I would pick.
Well taken and well noted as well. Thank you so much, Guy, for joining us. Well, on that note, we'll take for a very short break, but don't go anywhere, because when we return, crude prices is something that we will put our focus on. And joining us would be Peter McQuire from Exim Australia.